market.
The S&P, the ASX
stocks.
This is Motley Fool Money.
Welcome to Motley Fool Money, our very special Sunday mailbag edition with me, Scott Phillips, and him, Andrew Page. Andrew, of course, is the founder and managing director of strawman.com. G'day, Andrew.
G'day, mate.
I'm the CIO, Chief Investment Officer of the Motley Fool in Australia. G'day, Scott. G'day, mate. Sorry, you know what I mean. Just a bit of the two Ronnies for you there. All right. Mate, just to get me out of a hole, what is Strawman again? Let's talk about you for a minute.
Look, you know, it's actually pretty hard to get any coverage on small micro-cap stocks. The brokers just don't cover that kind of stuff. So we're a community. It's not really designed this way, but the focus very much tends to be on that end of town. So we've just got a bunch of smart private investors that have got sample portfolios and they add research and insights to these shared company reports. And yeah, you basically get a bunch of coverage and insights and hopefully a few investment ideas on some under-the-radar kind of stocks. And look, so far, we're smashing the market, so long may that continue.
There you go, mate. Fingers crossed for you and for your, do you call them members, customers, viewers?
I say members. Yeah, I think. Yeah, I really treat it as it's an investment club more than anything else. It's just we're an online investment club. So yes, members, all for one for all.
Mate, thank you for spending your time with us for the podcast. We actually have got some nice feedback for you, but I may not get to that because it's only so big we can make your head before we have to.
No, we can make time. I'm cool with that.
We'll see how we go. Mate, let's get straight into it. This is an unusual question, but a really good one. Question from Nick. G'day, Scott. I've got a question. You often suggest listeners see a financial advisor for more personal advice. Any tips on how or where to find a reputable financial advisor who isn't going to push their own agenda? Cheers, Nick. This is one of the best questions. It's bloody hard to answer, mate. It's such an opaque industry, isn't it?
Oh, it's so hard. Like, you know, I certainly don't want to disparage the industry because there are some awesome financial. No, there really are. It's like any industry. You know, there's just some of the people out there who just whatever you're paying them, it is worth 10 times that in terms of what they're doing for you personally. Unfortunately, there are a lot of bad actors out there. They're very much pushing their own agenda. So, look, I tend to think with financial advice that for a lot of us, the big ideas aren't that tricky. You know, spend less than what you earn, take the residual amount, invest it long term in some very sensible assets, and just wash, rinse, and repeat. You know, diversify, dollar cost average, all those kinds of things. It's not rocket science. It's kind of, I actually like to contrast financial advisory industry with the diet industry. You know, and I mean that in the sense that there are some great people out there that will help you lose weight and get fit, and they're awesome. Yeah. But at the same time, it's like, is it that complicated? Like it's basically, you know, watch what you eat and do a bit of exercise. And it's the same kind of thing with investing. That the things that are really going to move the dial, the big things that really matter, I think, you know, listen to this podcast for one. But, you know,
clearly that's the first thing we should do. Exactly.
Yeah, so I would look. If I had a financial advisor and knew some great ones to recommend, I'd be happy to give the endorsement. But I'm really just not in that orbit. So I don't know. Maybe you can offer a bit more help, Scott.
Doubt it. I'll do my best. Look, so a couple of things I would say. As you said, mate, not everyone's bad. There are people who are dodgy. There are people who are mediocre quality-wise. There are people who are mediocre because they subconsciously let incentives drive their behaviours. Now, the industry is much better than it used to be, and huge hat tip to the former Gillard government, I think it was, who introduced the Future of Financial Advice reforms that basically banned individual advisors getting commissions and kickbacks, which is a spectacular improvement for everybody, which makes the risk of getting a bad advisor, frankly, just less risky. Now, their groups still get incentives and kickbacks and payments, and there's plenty going on, so it's not a clean area, better than it used to be, so that's positive. So look, because of all those things, first thing I would say is, to the extent you can afford it, this is the hardest thing about financial advice is it's expensive to give. Let's call a spade, right? If you think about managed funds, if you had to write a check for the yearly fee to a managed fund, people would pull out tomorrow. But it goes unnoticed because they simply withdraw it from the fund balance. So you put let's call $100,000 in. Actually, let's call it $300,000 for fun. $300,000 in. Let's say the fund charges you 1%. That's $3,000 a year they are sucking out of your fund. Now, if you had to write a $3,000 check every year to that fund manager, you would maybe last 6 months, maybe a year, right? Be like, I'm not paying $3,000. I'm out of here. But because they get to withdraw it from your money, we know temperament again. Have I mentioned behavioural finance recently? Just once or twice. The reality is, because you don't have to pay it up front, people are like, oh, fine, okay, well, it doesn't hurt. You don't feel it. It's like paying up for the car. When someone says, hey, look, another $1,500 we'll fish oil your car. Oh, okay, I'm spending $50,000. I guess it's okay. If a guy came up to you in the street and said, hey, I just noticed you bought a new car, give me $1,500 to fish oil, you'd be like, go away. I'm not spending $1,500. So it's all context, right? It matters a lot.
And it's also there's something very well, maybe it is intentional. There's something deceptive about quoting fees in terms of percentages.
Yeah, exactly.
Because when you hear, real estate agents are great at this as well, right? It's like we take 2% of the commission on your house. You think, 2%, like it's nothing. I get 98%.
Yeah.
But when you convert that to dollar terms, it's like, wait a sec, that is a lot of money. Yeah, I think the best advice is definitely shop around, definitely go speak to someone. But if they're giving you hyper specific kind of stuff where you need to continually come back and they're pushing specific stock ID, that's probably a bit of a red flag. You want the people who are thinking long term, who are thinking more the habitual kind of things that you need to do, the structural kind of things you need to do in terms of how you're managing your debt and your cash flow and your savings and all of that. That's where the real value is. And once you've spoken to someone, they've given you some really good advice, that advice lasts a lifetime. And it's probably, frankly, it's probably worth thousands of dollars, that advice, if it's good and you're going to follow it.
And that's what I was going to say. So you want to, my point was going to be, look, you're going to have to pay for it. And so I want people to know that up front rather than get put off by it. Someone says, hey, I'll do your potential plan for you. It'll cost you $800 or $1,000. It's simply going to go, no, bugger off. I'll go to the guy down the road. He's not going to charge me anything. He's going to take it out of my fund. Well, guess what? He's going to take it out of your fund.
He's going to get more,
right?
Yeah.
Yeah, and frankly, and probably you don't know what the advice is. So the first thing I would say is go to a fee-for-service financial advisor who will charge you for the work that he or she does, but not get any kickbacks, payments, or anything else from anybody else, only from them. And do it for the fee up front on an hourly basis rather than a percentage of your assets, right? So go and see someone and say, I want a financial plan done. I need some financial advice. I will pay you for the hour. Give me a quote on what it's going to cost, and then either pay it or don't. But don't get sucked into the percentage game, as you say, Ram, because it'll happen every single year. I've given the example before of my mother, or my parents actually, when Dad was still alive. They were paying something like $7,000 a year for a $350,000 portfolio. It was, and for years and years and years.
It's obscene.
It makes me grumpy. I mean, it's my own parents, but it makes me super grumpy. Like, eventually, we pulled Mum's money out of there when Dad died, and we kind of, stopped that fee gravy train. But it's totally obscene. $7,000 a year for literally, a meeting, a handshake, and thanks for coming. Anyway, so it's going to cost you money, but pay the fee. Go to a fee-for-service financial advisor. Go and see 2 or 3 up front. Get a feel for them. Get a sense of what they want. You've heard our podcast, so hopefully you've got a little bit of enough knowledge to know what you're being told and whether that sounds reasonable and whether you think that person is someone who suits your personality, your needs, your expectations. Shop around. Go to some free consultations. Don't let them charge you for the first one. They won't give you the advice, of course, for nothing. That's fair. But go and see them, speak to them, find one you like, and then pay them up front to deliver you the financial advice. Suck up the cost. It hurts, but it's better to pay a large amount up front than an even larger amount in some sort of trailing annual fee for advice you may not love. So do that. All right, another one from another Scott. Hi, Scott and Rampage. Great to have Andrew back on the pod. I fondly remember his intros and was a subscriber back in his dividend investor days. There you go. Do either of you have any thoughts, right up your alley, mate, on rent.com.au as an opportunity with exposure in the financial wellness, payments and property sector? Not a lot of commentary around, even on Strawman, says Scott. I'm sure you'll fix that for us later, Ram. But in the meantime, have you looked at rent.com.au?
No, I haven't looked at it closely. It strikes me as a business that offers a really great solution. So I really do get the value proposition here. It's focused, obviously, as the name says, on the rental market. Yeah. It's allowing landlords to sort of manage things more directly. So speaking of fees, it probably helps you save a little bit in terms of paying a real estate agent to do a lot of the rudimentary kind of stuff. So it seems, and again, this is very high level. I haven't dug into this at all. It seems like an interesting business. And just having a very quick eyeball of their latest update, they seem to be getting good traction on their new product. Things seem to be moving in the right direction. So that's really interesting. Nice. One thing word of caution is that these are hard markets to crack into. They're one that very much depends on what we call a network effect. So at scale, they're just incredibly good businesses. Anyone who's sort of renting goes there. Anyone who's got somewhere to rent goes there because that's where the market is, and they tend to be very strong, reinforcing kind of things. Yeah. So and unfortunately, subscale, they tend to be very ordinary businesses. Like they just burn cash for a long, long period of time, or the economics just aren't great until you sort of get past a bit of an inflection point. Do you remember, was it Purple Bricks?
Yes, I do remember that.
I'm not sure. I assume they're still around, but it was a similar idea, and it basically allowed you to sort of sell your house directly, again, in a much more cheaper fashion than going through the traditional real estate agent portal. And I look again, without me getting on my soapbox, I think it's actually it was a really great idea, and you could get some really good outcomes with much lower fees. But you know what? It never took off. Yeah. So even though it had a great business model, I thought it had a legitimate product, definite value to all of their users. But for whatever reason, and there's probably a couple of reasons there. When it comes to selling your biggest asset, people just don't want to take the risk, and you feel safer in going with a quote unquote professional, which was probably the nub of it.
Hey, be nice.
It wasn't. It wouldn't have been a great investment. And this, and I'm not saying this is going to go that way, but that's for me. If I was going to dig into this, I think I would really want to see some very good traction in terms of user uptake and growth, and that they also importantly managed to achieve that growth with a good bit of cost discipline. There's plenty of early stage companies who actually do grow their top line, their sales very strongly, but it's just that their costs grow each year in line with that. So it never really sort of hits its full economic potential because on a profit line there's just nothing that really emerges, and there's lots of capital raisings and the rest of it. So definitely not the kind of detail and nuance you'd want from someone if you're going to make an investment based on that, but hopefully some high level thoughts that help.
Yeah, I like it.
Have you looked at it?
Look, I have a while ago when it first. Well, I was going to say when it first listed, it was actually reverse listed into an exploration company, believe it or not. So it's one of those businesses that wants a place on the market, maybe deserves a place on the market. But as you say, mate, this is one of those. I won't go on too long a tangent here, but when it comes to growth companies, or even companies with big potential, that kind of just the raw, like as you say, really big market, right? The chance of it being successful is really low, but when it does really, really well. Yeah. It's one of these companies where almost like an explorer, right? It's trying to break into a market, and Airbnb broke into the accommodation market, Uber broke into the taxi market. These things are possible, but are they likely? Well, that's a whole different story, right? So, ironically, it seems to be that for now, at least, the financial incentives and frankly costs to use something like rent.com.au, it's just not as attractive as if you're selling a house. If you're selling a house, you'll pay $1,000 for an ad because you have to and you can, and you want to sell a $1 million plus property, you're going to spend whatever it costs to get it sold because the cost is a fraction. Speaking of percentages, costs are a fraction of the price of the asset, right? In the case of rent, well, the agents are already using their own platforms, their own portals. The consumer's already in a certain place. The rent rolls are collected and transacted basically by a party of the agent's own choice, where the agent is getting a nice little bit of money from the rent manager for that purpose.
Okay,
and so it's kind of one of those things where the market's kind of already built to suit the current incumbents, and it's really hard to see what rent's doing differently enough. Not that there's rationally, the company will be yelling right now saying, look, all the things we do, this is why it's better and different. It's like, yeah, get it, but can you convince enough people to make that change? So it's kind of a network effect in reverse. They're going to have to win a whole lot of people over without a really, really, really clear incentive for enough people to do it strongly enough to make a big, big difference. Now, if it gets it, maybe it's the next domain, right? That's what they're hoping to be. But it's just a really tough area to break into without sufficient financial incentives or size or kind of enough money at play, frankly, to make it worth anyone's while to do it. And that's what's making it really, really hard for it to break through.
Yeah.
Mate, question from Paul. Hi, El Presidente and Ram. Thank you, Paul. I enjoy you listening to the podcast for many years. Thank you, mate. As you put a call out for questions, I thought I would ask one. I have a share that is down 90% plus, but I can't sell because it's worth less than $100. What should I do, or how can I sell it to realize the loss to offset the gain I made for tax purposes? Regards, Paul. Oh, painful, mate. I've never lost that much on a single stock that I own. I have got one, Essentia, which we sold for more than a 90% loss at Share Advisor. So I honestly feel your pain, Paul. I'm sorry to hear it. Ram, what should he do to get rid of these shares and get his capital loss?
Well, I guess Paul's talking about a rule with his particular broker, which they just don't do transactions if it's less than that, which is a bit disappointing. I guess you can it depends if your shares are CHESS sponsored or issuer sponsored. If they're issuer sponsored, that is, you have a shareholder reference number, you would have got that in the mail. You can actually sell it through another broker, and I'm sure there'll be others out there that'll happily take the transaction. Maybe worth even just calling to see if they can make an exception, because on one hand you're going to think, well, it's less than $100, you just write it off. But as Paul rightly says, there is a tax loss there that he can use elsewhere, and he wants to sort of at least get that benefit. So I would not accept what your broker is saying. And if you are CHESS sponsored and they still won't do it, well, you can still go to another broker and transfer it across. Bit of a hassle, bit of a pain, but yeah, hey, if they're not going to do it, then take your business elsewhere.
Yeah, exactly. That you can absolutely. Most brokers, if you call them, will actually make the sale for you, and often brokerage free, just because to help you out. They've got discretion to do that sort of stuff. So absolutely start there. You can, in some circumstances, also gift your shares. So whether you want to or not, it's up to you. But you can dispose of them. The Share Gift is an organisation that works with some brokers. You can actually gift those shares. That's a sale for the purposes of tax. So not only do you get the deduction for the capital loss, which is unfortunate, you also, you can help out someone. You may not want to, you might want your $100, right? So I'm not saying you should do this necessarily, but if you're happy to, give away $50, $80, $70 worth of shares, you get a tax deduction for the donation, of course, and you get to recognise the capital loss. As I said, after that loss, you may just want some money back to salvage some pride, which is fair. But if you don't, that's another way you can do it. But otherwise, calling your broker should do the job.
Yeah, that's a good alternative, mate. I forgot about that one. I really like that option.
Now, here's one from Lucas. I like Lucas a lot, Ram. Can I just say up front, Lucas is not a relation, but I like him a lot. Lucas says, "Hi, Scott. Question for the pod. I've been listening since about August last year and have since invested a decent amount. I really enjoy every week's podcast and learn a great deal. Don't worry," he says, "you're still a handsome bloke." Lucas, you are. I don't have favourite listeners, Lucas, but you are my favourite listener. All I'm saying. If the rest of you bastards would be kind enough to actually be properly polite and kind and thoughtful and frankly as objectively honest as Lucas, I think the world would be a better place, is all I'm saying. So, you don't have to, but Lucas obviously sees something the rest of you people... All right, I'll move on. He then says, Andrew, he didn't make this one up. Lol. I'm wondering what a cheap but great way to keep on top of all the accounting of dividends, gains, losses without much work, as it's going to be my first year of taxation as an investor. As some companies pay fully franked, partially franked, and no franking, how do we make it easy for the accountant at the end of the year? Especially when we're meant to hold a dozen plus companies for diversification. Full on from Lucas. Well, Lucas is very, very smart, very capable, very funny, very insightful, very thoughtful. I can't speak highly enough of Lucas, Ram, is all I'm saying. So hopefully we can help him out. What do you reckon, mate? There are some expensive options, but he's a new young investor. He probably doesn't want to pay a lot of money. How would you go about it if you were on a shoestring?
Well, if I was on a shoestring, and what I did for a long time, I just had a spreadsheet that I just updated with all of my trades. Name, date, value. It's a bit of a hassle, and you fill it all in, and then you'll be able to work out at the end of the year what it is if you're doing your tax yourself, or if not, you can give it to your accountant, and that gives them all the info they need to properly account for it. Yeah. I want to give a plug here, and I should state we do have a commercial relationship with these guys, so take that for what it's worth. But I do recommend ShareSite to our members. It's basically what you do is you connect it to your brokerage account, so it's kind of like Xero except for shares, and it helps you really track your portfolio and your performance. But at the end of the year, you just press a button and it produces all your capital gains and income reports. It's just super easy. And if you go to our blog, so strawman.com/blog, you'll see the second link there is for a promotion for ShareSite. They get the first 4 months free if you sign up through us. Helps us out a little bit too, but I would check that out. But honestly, you can entirely do this yourself. It's just a question of how much work you want to do. If you're the kind of person who trades 10 times a day, I would definitely recommend something like ShareSite, because you're just going to drive you mad. But if you're like most people and you're only buying a few things throughout the year, it's not that hard, and you can easily do it yourself.
Nice one, mate. I want half of that endorsement check, by the way. We'll talk after the recording. Look, yeah. So I use and like ShareSite as well. I like the company. I like the people. I'm a user. I have no commercial relationship at all, but also still like it and recommend it. So yeah, it is really good. It's not cheap though. If you're a new investor, young investor, you're getting started, it's not that complex. You may not want to shell out for the money, and I wouldn't blame you. I don't think ShareSite would blame you either. They also do have did you say they have a? Did you mention they have a free?
I think that you can do it for free if you've got less than 10 stocks in your portfolio or something like that.
It's a way to get. You can kind of trial it out. Honestly, the Excel spreadsheet is not a hard one, particularly in the short term, right? If you just record your dividends as you get them, you can the data's all on the dividend statements you'll receive from the brokerage or the registrar. Sorry, so it'll have cash dividend, franking credits, all that stuff. You just literally put it on 2 columns or 3 columns. Put the date, the dollars in dividends, the dollars in franking. Roll down the slide, and you've got a total. You can get reports from the registry itself, which has a lot of information on it, of course. But you know, to the extent you've got a smaller-ish number, even if you've got a dozen shares, they pay dividends twice a year, and if you're not selling, then you've only got 24 transactions to highlight. It's really not that difficult. So I know it can feel a bit overwhelming at first, but if you start, literally grab yourself a spreadsheet, call it My Dividends, and then just whack your dividends in. Also, somewhere else, grab another one, call it My Share Purchases or My Share Purchases and Sales. Put the date you bought, put the price you paid, number of shares, and then if and when you sell them, you put that somewhere else, and then you've got a running tally. Once you've got a lot of it, it does get more complex, and I would also recommend ShareSite, but without Ram's money, although, again, I'm going to talk to him after the episode. But just generally speaking, I think it's a very worthwhile option. But in the short term, honestly, an Excel spreadsheet, or you know what, if you don't have Excel, grab a Google sheet. I'm a Google shareholder for the record. Not that's got anything to do with it. But you know, like if you don't want to pay for Excel, if you don't have it at home, for example, some people don't have an Office subscription. Google Sheets is free. Grab a Google Sheet, do the same thing. Super, super easy. So hopefully that helps.
Value stocks.
Market.
Stock market.
Index.
Share market.
This is Motley Fool Money. Subscribe to the free newsletter at fool.com.au/MMM.
One from Rodney, mate. And I like this one from Rodney's keep tabs on you, mate. The internet remembers. Rodney says, "Hi, Scott and Sage _Simeon." He's referring to you by your Twitter handle, which is kind of just weird. I have a question regarding Nanosonics. When Andrew was on the podcast the first time around, back in the deep, dark ages, I still didn't have hair then, but it was a while ago, I remember him saying he thought Nanosonics was cheap at around $2. Now at approximately $5.30, does Andrew still think Nanosonics is good value? And he says, I don't know. I'm going to assume this is a genuine question, not one of those passive aggressive ones. He says, is he able to explain how he has come to his valuation? Thanks, and fool on from Rodney. So Rodney's either trying to give you a hard time or genuinely curious. Do you still like Nanosonics at $5.30?
Mate, anyone is welcome at any stage to bring up a stock that I've done well on, because I will happily talk about. I actually first bought it in 2014. So here's a lesson in the value of long-term holding. And I've bought and sold a little bit along the way, just managing my position. But I first got it at 92 cents, so it's been very nice. About 46% compound, according to ShareSite, over the last 6 or 7 years. That's very nice. But I was able to, I'm getting better at this, to overcome some of those anchoring biases. So when Strawman launched, I actually put it on my portfolio there too, obviously at a much higher price, but then that's done really well for me too. And it's come back, as it always does for me, with trying just to compare what Mr. Market is offering me versus what I think it's worth. And it's a question that always comes up. It's like, well, people always want to know, what are you buying, why are you buying it, and what do you think it's worth? And to answer 2 questions in a row with a shameless plug, that's
welcome to the Strawman Show, where Andrew gets to plug his own stuff and get paid for doing it. Jeez,
it's serendipity, but it's kind of the exact point of Strawman. So rather than ask the question, all you need to do is go to Strawman. I'm Strawman as my username. So go strawman.com/Strawman. You'll see what I'm holding. You'll see that Nanosonics is in there. you'll see a 15% compound return over the last 3 years, which is nice. But click on that. You'll be taken to my report. You'll see I've got a valuation that I last edited 4 months ago at $6.15. And then there's a little bit of a description as to why I think it's worth that amount. So that's the easiest way of answering that.
All right, I'm just going through the next question to make sure there's no obvious opportunity for a plug. I think it's okay so far. No, that's good. That's good.
Yeah, it is kind of. I think it's nice because it just sort of basically says, well, if you want to know that stuff, will go there. That's the point of it. But also too, and a little bit of a segue. I always think, outside of Nanosonics or Strawman or whatever you're doing, just that act of writing it down. Why do I like this? What do I think it's worth? Why is this the best opportunity? That is such an immensely worthwhile exercise to do. So, and if you can't do that, if you sort of sit down and figure, and as you start writing, thinking, actually, I'm struggling to justify this, that alone is a very valuable signal as well. So that's the process I do. That's what Strawman's all about. But do it for yourself either way, because you'll be a better investor because of it. But yeah, for what it's worth, I think it's still reasonable value.
Mate, I'm going to ask you a slightly pointed question, but a genuine one on the back of that thought. And it just occurs to me that I am in complete agreement with you about keeping a journal and explaining your recommendation or your thoughts, your buys, your whatever's, depending on how you do it, to your diary. We do it at the Motley Fool. Every recommendation has one. You've done it on Strawman. So, I agree with you that it works. I'm curious as to how you think. Let me phrase this well. So I'll make it a statement. You can respond to it as a question.
Okay.
My first thought when you were saying that was, you talk about the value of kind of just that benign neglect, right? Just kind of hanging on, letting time do its thing, not getting too involved. If you were forced to go back and re-justify a valuation every 3 or 6 months, do you think it might have made you more likely to sell that because at some point you got a point it's like, oh, I can't possibly keep holding now. I'm thinking about Amazon for myself, for example, of like, if I had to put pen to paper for our members at Motley Fool, for example, Amazon's a recommendation of our US scorecard for Share Advisor. I own it personally. If I had to every 6 months go back and say, okay, now I think it's worth X. Now I think it's worth Y. Now I think it's worth Z or Z, being an American stock. I wonder whether that process would have ended up talking me out of doing it. Do you have a thought or a way to avoid that, or just kind of, do you think it's a risk? How do you feel? And again, not bagging Strawman at all. I think it's a great platform. I'm just curious as to how you might get around that idea of the benign neglect almost goes away if you kind of keep going back and updating things. Does it make it more risky, less risky? Does it kind of focus the mind? Does it run the risk of making you more or less likely or more or less locked in because you're justifying it over and over again? How do you kind of feel about that part?
Yeah, it comes down to how honest you are with yourself. But Nanosonics is a good example. If you go to my report on that, you'll actually see that just in the last year, I've actually changed my valuation 3 times.
Okay.
And there is the chance of trying to be too clever by half and trying to just constantly judge this thing. But the reality is that one or two things will happen. One is that new information will come to light. So I've thought that Nanosonics was worth X because I felt as though it was capable of doing, whatever. And then we've had a few more company updates. We've had some results. Maybe they've made an announcement. They're issuing some new products or something like that. And then you think, well, actually, I was wrong. Or sometimes, or not wrong, but maybe I need to update my thinking. Maybe I was either a bit too ambitious, or maybe I wasn't ambitious enough, and I'll change it. But so I think it is worth keeping your finger on the pulse, because things do change, and the best expectations don't always come to pass. Even the interesting thing is, and this is the hard one, is that even when the news doesn't change, and maybe you do get a few company updates, but it's not, the same expectations, nothing's really changed, your interpretation of the facts can change. I mean, as you just get a bit more experience, as you mature, as perhaps other people have offered you new perspectives, you can actually come up with a new valuation without any new information. Maybe I just don't want to put as high a multiple on things, or maybe I feel as though a different discount rate is. So it's a very slippery kind of slope that you can get on. But I just think there's value in always thinking about that. And when I do valuations, I always try to avoid the hyper specificity that I think plagues a lot of investors, where they've mapped out forecast income statements for the next 10 years. And, it's just so down the rabbit hole. But I have to then have forecasts for 20 different variables. And it's so hard. So for me, particularly a growth stock like Nanosonics, I'm really sort of saying, listen, I think they should be able to grow their top line by, 15, 20% per year. It's of a flavor. It's not of a hyper-specific thing or, in 6 months they'll be earning this. In 12 months they'll be earning that. Yeah, and so when you get the inevitable wobbles in there, it's not like you're looking for something where it's just like this was fundamentally flawed rather than I was a little bit out in my expectations. So if 5 years' time we look back and this thing has grown at 14.8%, and maybe my forecast initially was something at 17%. That actually makes a bit of a difference, but it's not it's not a mile away, and it's not like I'm going to if my valuation is wrong, it's not going to be massively wrong. So keep it better to be generally right than specifically wrong.
Yeah, I like that. I think it's a really good way to put it. Very nice. Anyway, I just appreciate you going that much. Just thought I'd ask because it occurred to me. Here's one from Jeff. Hey, Scott and Andrew. I'm a long-term Fool member, both here and in the US. In fact, I joined the Motley Fool because of Andrew. Jeez, Jeff, come on. Help me out here, dude. At least, anyway. I joined the Motley Fool because of Andrew after listening to his foolish wisdom on the Sky Business Channel. It's good to hear him again on the podcast.
Back in the day.
I agree, Jeff.
Yeah.
I retired in March, says Jeff, after getting an offer on my business that I wasn't expecting. Good man. It wasn't a huge amount, but it gave me a cash buffer I needed. And thanks to the Motley Fool, my investments allowed me to retire just before my 60th birthday. There you go, mate.
Awesome.
Right. Because of the unexpected offer and the quickness of the sale, I never thought how I would access my super. I'm now taking it as an account-based pension quarterly at the moment. They say when you invest an amount of money, your returns are better if you invest it all at once instead of dollar cost averaging. But what about when you are withdrawing funds from super? I assume it would be the reverse, and it would be better to take a fortnightly pension rather than taking a single annual lump sum to allow your remaining super to compound. Does that make sense? Assuming you are using the money to live on and not reinvesting it outside super. Thanks, Jeff. I love this. He says, P.S. Sorry for the rambling. Please head it how you want. But I did want you to show you both. To show the both of you and CMF US my appreciation for allowing me to be financially free and to be able to retire early. I started investing 11 years ago, and I didn't think it would be possible. But thanks to the Motley Fool, here I am. It shows it's never too late to start investing as long as you have the right guidance. Thanks, Jeff. That's
really cool.
And well done, mate. Thank you for bringing him to the Motley Fool all those years ago. Good question, right? So generally speaking, I've been a fan of the market tends to go up. So if I had a lump sum, I would put it all in up front because that's just rationally what I think is best. I have said similarly, though, that many people prefer to do it slowly because the psychological benefit of that is easier. If the market goes up quickly, you've already got some in, you at least make money. If the market falls, at least you've got some outside to put in. So you kind of, psychologically, some people benefit more from putting it in slowly. But as I said before, rationally, I think it makes more sense to put it in quickly. Jeff's asking the reverse question. He's taking some money out of super. He's saying, well, how do I take it out? What's the best advice for taking money out of super? What do you reckon, mate?
Yeah, I would say that if you don't have any need for a big whack of capital, then just keep it there, right? There's big tax advantages to doing it. It's going to pay you a little bit of an income to live off. And if that's all you need, then that's probably the best bet. But again, as always, it depends. If you do need a lump sum of cash because there's something that you want to buy or do, then that's a different story. So it is a bit of a personal one. But assuming that you're more than comfortable with what it's paying you, and you're retired, you've got an income coming in, it's what a great scenario to be. Still very young, tender age of 60, decades of life ahead of you, and you don't have to work anymore. And that's it. That's the goal. Yeah, job done. I would be tempted to continue it, to leave it there. It also depends, of course, what that super is invested in. Yeah, having a bit more time now at your disposal, not having to run a business, I'd probably spend a bit of time having a look at how it is invested and maybe thinking how you could improve that. Again, not trying to be too clever, and certainly not suggesting you start day trading or anything like that. But have a look at that. Leave it in that structure. You'll get some real advantages with that, and gives you a bit of a hobby for your retirement years too.
No, that's why I like it. I'm not going to. So this is a plug show all of a sudden. I'm not going to plug the service, but I'll mention it. Motley Fool Everlasting Income is a service that we run specifically for that purpose, Jeff. And I'm not saying you should join it necessarily if it doesn't work for you, but I'll use it to explain what we do. So effectively, we have built a portfolio which is designed to generate income. And we have we actually do literally have a cash account for the Motley Fool. We follow it with our own money. We put $1 million of the Motley Fool's money into it in 2017, and every month we take out an amount of money as a what we call a paycheck, right? So it's to mimic getting paid every month. Do it every fortnight, it'd be the same thing. You just change the amount of money. But we basically have dividends go into the account regularly, and then the money coming out of the account monthly to basically mimic exactly that, to living off that money. And so depending on how your portfolio is structured, what stocks you've got, how much income they generate, how much you need the cash, generally I would actually go with something like that sort of approach. We carry about 4% of the portfolio's value in cash, just to allow for the ups and downs of dividends. So when the dividends all come in, that goes up to 5 or 6%. As the dividends flow out, they might drop to 2.5 or 3%, and then it goes back up and so on and so forth. And we kind of use that to allow for that process to happen. And it's worked pretty well for us thus far. The results have been pretty good. But again, whether or not that's, I'm not here to sell. I'm just here to say that has how we've structured that for exactly that purpose, right? You don't have to take the money out when the dividends are paid or guess how much is going to be paid. You use that cash balance, that cash account to actually do the work for you. And it seems to work pretty well thus far. So I would do something like that. The challenge you've got, because you've got a twofold challenge, right? Because the first is you've got to sell down some shares, and then you've got to take out the cash. And are you selling every fortnight, take the cash out, every month, take the cash out? Are you selling semi-regularly, or are you living on the dividends? It's a much bigger question than kind of, how do you do it? Maybe you just got an industry or a retail super fund where you just tell them to send you some cash every month or fortnight, and they do it for you, and that's a different question again. So it depends on how kind of what structure you're using to manage your investments. Generally speaking, I just take the money out. I would probably plan to Ram's point, you want to invest well, and then just plan how much you want to receive every month or fortnight, and then just have it done as a quasi paycheck, right? You're a small business owner, so you're probably not used to being paid regularly. But I divide it up. So, right, what do I think I'm going to earn from this portfolio? How much do I need in cash? When do I need it? And if it's okay, I'm going to pay myself X dollars a fortnight. Just have an automatic transaction that goes through every fortnight, dumps money in your transaction account for yourself, your personal account, and that way you're getting the money you need. Now, of course, just quickly, the other thing to think about is making sure you meet the requirements of the allocated pension. So there are some requirements of how much you must take out. So of course, be mindful of that. But short of that, that's how I'd think about doing something like that sort of approach. Does that make sense, Ram?
Nice. Yep, definitely. No argument there.
Now, speaking of people who are nice to you, I don't know why I didn't vet these better. We got a question. A regular correspondent who I don't think has asked a question or sent us an email since you've rejoined us. Little Miss Hairy Legs, a regular correspondent, and she sent us a message. She says, "Hi Scott, I hear you need questions. Here's one for Andrew, because I went to strawman.com and it's free membership." She says, which means I'm the product, right? I like that. And I can't see any advertising. So how does he make money? Hashtag help Andrew. She's worried about you, mate. Little Miss Hairy Legs is saying, Andrew's, I'm worried about it. I'm going there, I'm using his product. I'm kind of happy, but he's not charging me for it. How does he make his money? Do you care to comment, or is that in the annals of small business secret sauce, and we'll talk about it later?
No, it's a really legitimate question. I love that saying, by the way. I forget maybe it was Bezos or someone who said it. And if you're not paying for the product, you are the product, which is so true, right? Like everyone goes, Facebook is free.
That's right.
It's the same in like free-to-air TV. Yeah. It's free-to-air because,
right.
It's being supported by a different model. So people obviously ask all the time. It's because there's no advertising on Strawman. As I mentioned before, we've got like a couple of referral arrangements that we like with ShareSite. We say, hey, if you like them, you'll get a discount. And
Unbelievable.
But I got to tell you, we bleed cash. We don't make any money at all.
Hairy Legs, that's the answer.
Yeah, so it's hard. It's hard to call. It's hard to call Strawman a business. Now that's obviously not viable long term. And in fact, there's something that's really exciting that's just on the horizon that we've been putting a lot of work in. But it's actually a question that has really forced us to think long and hard on exactly what we're trying to build here. We actually get a lot of offers from investor relations people and stuff. So what everyone in the market wants is access to new investors so they can flog them a bunch of stuff. So on one hand, it's very tempting to say, yes, I'll take that money. And then I'm just going to like ram a bunch of, emails down people's throats and really annoy them. I just don't want to do that. So we've had to think about a model that allows us to be viable but doesn't do that. And the one that we've come up with, I think it's really nice because it aligns our interests with our members. But I don't want to give away too much away. All I'll say is it won't be. Put it this way: Strawman will always be free. So we're always going to have a free offering there, so you can go on, play around with the sample portfolio, see a lot of great content. But we are going to have an additional layer on top of that, and watch this space. It should hopefully be out in the next couple months.
Oh, there you go. All right, you heard it here first. Thank you, Little Miss Hairy Legs. I'm not sure we'll go with the hashtag Help Andrew for too long, but thus far, that's what we're using, Help Andrew. So thank you.
Help
thank
Andrew.
You for the question. I don't know if I'm going to help you. I'm just mean there's going to be better hashtags, that's all. All right. You're not doing a GoFundMe campaign yet. That's the positive, right?
Not yet. No,
you're not at that stage of the business, so we're okay. At that point, we will reactivate the hashtag, but until then, we're all good.
Exactly.
All right, here's one for Stephen. Hi, Scott. Thank you to you and Andrew for always taking the time to do the podcast. It's a great listen and the only podcast I listen to. That's a big rap. All right. Stephen says, I'm in my late 30s and I've always loved gambling, especially in the early years. Then I realized what it was all about. Losing. He says, from cane toads in Fiji to crabs in Queensland, I've backed them all. My question is, how do I not invest in every idea I hear about and just sit back for 5 to 10 years and see what happens? Or how do I know which ones to select from the 25 companies that I'm watching? I currently have 40 grand in 11 companies at the moment. I wish when I was 20, I knew how easy it would be to get into investing. I would be so much further financially. As with investing, you can sit the lows out. He is dead right, Ram. It's a great question, a great comment. It's, you know what? Good thing is, Stephen, mate, you're in your late 30s. You've got plenty of time left. You've got probably 30-odd years to retirement, and then, good Lord willing, the creeks don't rise, another 30 years of life in retirement. So you've still got a 60-year investing career ahead of you. So, mate, yes, we all wish we started earlier. Warren Buffett says his biggest mistake was starting at 11, not earlier, which is a nice problem to have.
Yeah.
But the point is valid. We always wish we'd started earlier. But as the it's the old thing, the best time to plan a tree was yesterday. Second best time is today. So let's move forward from here. It's a good question, mate. It's tempting, and particularly with Stephen's background. I'm gonna assume that without casting aspersions, these tempted by the next big thing, the kind of the tip from the mate, the equivalent of the stock market mud crab or cane toad, might possibly win the race. What if I miss on the next one? The whole the FOMO thing is so real for so many people. How do you avoid FOMO? How do you find the companies worth owning?
Yeah, I think so. Here's a hard reality of it. I think everyone in the finance industry is out there trying to tell you how easy it is. Oh, yes, their value to long-term investing. Oh, it's so easy. Buy our charting package or buy our this, and you're going to make $1 million. And it's sort of the reality.
It's only easy when they're selling you something, right?
It's not easy. If it was easy, we'd all be Warren Buffett. It's hard. It's like if you want to be really great at playing the piano or tap dancing or tennis or golf or whatever it happens to be. It's if you want to be good at something, it requires a lot of work. I would argue that effort is very much worthwhile because one, I'm the kind of person who enjoys it, enjoys the process. So even if I had $1 billion, I'd probably have a portfolio that I'd manage just for fun. So yes, it's very much it's fun, but it's so much worthwhile doing it. You only need to get a few big ideas kind of right over your career, and it's so life changing. As long as you can get rid of that get rich quick mentality and focus on that building of wealth, that idea of just always building, build, whether you're 50, 40, 70, you're always just adding to this compounding machine. It's just such a beautiful little thing to nurture. And so take it seriously, put in the work, know what you own, know why you own it, and always be learning. And I think that'd be the best way to do it. If you can't, as we said before, if you can't write down on half a page of paper what it is you're buying, why you're buying it, why you think it's good value, well, that's an instant pass. Even if it turns out to be great, you shouldn't invest in those kinds of companies. And keep going until you've got a list of stocks that you can. And I get in saying that for a whole bunch of people who aren't as nerdish as you or I, that sounds like really boring, hard work. And I totally get that. In which case, it's really easy. He says, how do I not invest in every idea? I'd flip it around and say, why wouldn't you invest in every idea, but do it through a broad-based ETF, gives you exposure to the market. The only way you can lose is if society collapses. Do you know what I mean? So it's kind of like they're the two extremes. There's no halfway, or not much really of a halfway. You either take the passive approach and you'll do very, very well over the long term, or you take it very seriously and you get into it. And although it's a bit of work, you'll probably do even better if you're smart about it. So. Yeah, just go beyond the initial idea, because take it from me, I get every other day I get someone telling me this great idea that's going to be the next 10 bagger. Maybe it is, but your job as an investor is actually to say no. We've got this luxury of choice. There's literally thousands of companies out there. You have to be saying no, 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 no all the time, and it's only when you find it very hard to say no because it's so compelling. You've got so much conviction. You've got so much. You've done so much work to really understand the business. That's when you think, okay, now I've got something that I can sensibly invest in, and that's the way to go.
I like it. I'm going to go completely the other way, mate.
Okay.
I think you're absolutely right. I think you're absolutely right, but I don't agree with any of it, except I'm going to just present an alternative option. Because I'm going to, again, unsurprisingly, as I do almost every weekend these days, every weekend, go into the psychological part of behavioral finance, the reality of what's going on. If you are, Stephen, someone who just can't resist the urge of the punt, the other option you got is to do completely opposite of what Ram said and go straight to an ETF, an exchange traded fund. It is boring as buggery. It is not very exciting. You're not going to make a fortune. You're not going to back the next thing. But if you make yourself do it and make that your investing, you just simply take the whole question out of the equation, right? The old, do I walk past the TAB with $100 in my hand and duck in and maybe put a 10 or $20 on a couple of the next round week? Well, you could, and maybe you make some money, maybe you don't. If you can't walk past and put that money straight in the bank, avoid the whole thing altogether by simply getting a transfer from the bank account into an ETF or a managed fund, or get a broker to do an automatic transaction or automatic purchase for you, and just literally systematize the whole thing. Andrew and I both pick stocks for a living. We both think it's possible to beat the market. So those things are really, really possible and very much worth doing. But if you're not someone who feels like that can be done successfully for you, and plenty of people can't, right? It's not a criticism, it's not a judgment, it's not anything other than, as you said in a previous question, Ram, know thyself. If you're not someone who can do that well, or you're not worried you mightn't do it well, or you just want to save yourself from yourself, some people need that discipline. And it's not just this, by the way. It's not just the gambling temptation, it's the budgeting temptation. That's why we say to people, pay yourself first. Don't wait and see what's left at the end of the month to put some money away. Pay yourself on payday. Put some money away then, so you're not tempted to just wait and see what's left. You actually take the money out in front. These they call them pre-commitment devices, right? In the literature, and the idea basically is exactly that. You just pre-commit to it, so you don't have to think about it. You don't have to worry about it. By all means, go and find the best stocks you can. But the alternative is to do the exact opposite and say, you know what, individual stock pick is not for me. I like business. I like listening to the podcast. Love the idea. But you know what? If you only, in air quotes, only, and you can hear my laughter, if you can only get 9 or 10% a year in an ETF for the next 45, 60 years, you will be spectacularly rich. So if you can put a decent amount of money away, of course, but the compounding value of that, if you can regularly put some money aside, that'll well and truly cover you for anything you need, anything you could possibly need. And so if picking stocks is not for you, if you can't follow Ram's advice, and if you can, you should, but if you can't follow that advice, then you can walk it back and just simply go to the ETF option and go from there. Is that fair?
Yep.
Hey, a double from Patrick, mate, to finish us off. I'm not sure whether I'll... here we go. I'll give you his recommendation first, his advice first.
Okay.
He says, something for Strawman and the podcast. Is another way to introduce Strawman simply to call it fantasy stock picking, like fantasy football, with details of the process, the individual stock trades and prices included. So there you go, mate. There's a free one for the next time we record a podcast. It's like fantasy football, but for stocks.
I can't believe I haven't used that one already. Yeah, that's a good one.
There you go, Patrick. Mate. I don't want to tell you what you should do, Patrick. All I'm saying is, if you use your advice, you probably should send him an invoice. That's all I'm saying. All right. He does have a question. He says, "Hi, Scott and Andrew. I've been enjoying each episode since the beginning of the year, and recently realised one of the best things about it is helping one reflect on one's investment decisions, including the mindset or psychological processes one goes through when investing. I really appreciate this emotional or psychological part of your advice, as well as the intellectual side. I have a simple question. I can't find an ASX listed New York Stock Exchange ETF. Am I missing something? There's ETFs for almost everything, including big ones such as the NASDAQ, World League companies, etc., but nothing specifically for the New York Stock Exchange. Grateful if you could enlighten me about this seeming anomaly or if I've misunderstood something. Thanks, Patrick. I'd never thought about this question, mate, but he's right, isn't he? I'm pretty sure there isn't a New York Stock Exchange ETF.
Yeah. Although I guess if you go for the S&P 500 or one of those broad-based ones, you're pretty much getting everything on the New York, all the main ones on the New York Stock Exchange.
That's the you're getting New York plus NASDAQ, right? So they pick the S&P 500 is exchange agnostic, whereas the NASDAQ index is just about the NASDAQ itself.
Yeah,
I think that's his point. There's you can get the NASDAQ, you get one exchange being the NASDAQ, but you can't get an exchange base for the New York Stock Exchange. Patrick, you're absolutely right. I would say, for what it's worth, I don't think, each to their own, I wouldn't be looking for just a New York Stock Exchange ETF. I don't know that doing so, unless you wanted to pair it with a NASDAQ ETF, for example, get kind of both US exchanges, which you could do. I don't know that you need to or necessarily, I'll speak for myself, I wouldn't necessarily want to. I wouldn't choose an ETF that specifically excluded NASDAQ or specifically wanted only the NYSE. Simple example, I like Amazon, for example. It's on the NASDAQ. I like Berkshire Hathaway. I own them both. It's on the New York Stock Exchange. I don't want an ETF that has one, not the other. Now, they're very, very different businesses. And if you said, look, I don't want any tech stocks at all, I just want New York Stock Exchange, I guess that's fair enough. Same as people do in the reverse. I guess they buy the NASDAQ because they want those stocks. But yeah, no, there isn't one. And largely because I think the way it was born, the S&P 500 was always the premier index. And when there was no NASDAQ, or even when the NASDAQ was small, because the S&P 500 originally was born on just the New York Stock Exchange, because that's all there was, it effectively was that. But as the NASDAQ was added, the S&P got bigger and broader, and there was no real need to replace it. The NASDAQ Exchange ETF was born largely because people wanted access to these new up-and-coming companies in a way that made the whole idea much more attractive. In the US, there may well be a New York Stock Exchange ETF. I'd be surprised if there wasn't. There's more ETFs than stocks in the US, so there may well be one there. But for what it's worth, it's a really good question. The answer is no, there isn't one on the ASX. But I also, just for what it's worth, would say I'm not sure you should want that or be looking for it necessarily as an investing idea. I'm not sure there's an investment thesis that would underpin issuing the NASDAQ, just going with the New York Stock Exchange. But that's just my personal thought. Your thought, Ram? Do you know of one? Do you think it's a good idea or a bad idea? Do you have any thoughts or feedback?
No, it's really made me think. I don't know of one, but now that I think about it, it's like, why isn't there one? Because the calculus for the issuers here is not necessarily is it a good idea, but can we sell it? And that's right. So they've potentially missed a trick on that one. But I come back to your point. I mean, I actually think that the better companies in the US are on the NASDAQ. That's where I think we're still, a lot of us are in that mindset where the NASDAQ, being tech, is all very cutting edge, much riskier kind of stuff. But you look at the kind of companies that are listed there, and they are just so deeply entrenched behemoths within their industry, gushing cash. They're very likely to be. I mean, we could call them blue chips with a straight face, I think. Valuations maybe aside for some of them, but in terms of the endurance capacity of the business and their cash flows, these are wonderful business. So I certainly, if the best I could do was buy a broad-based US index, which was a lot of NYSE, but also a bunch of NASDAQ, I think that's great. You want the Googles and the Amazons and all of that other kind of stuff, and the Netflixes and that. They're great businesses.
Yeah. It's a really good point, and that's my broad point. I think once upon a time, S&P was the New York Stock Exchange. It just they took the biggest 500. That's what they called it, and then someone at S&P decided they should probably add big companies that weren't on the New York Stock Exchange. Because it made no sense to exclude them, but when you do that, it didn't make any sense to have something an S&P X NASDAQ just made no logical sense.
Yeah,
but we're done. We are finished. Thank you, fools, for listening, sharing some time with us on this particular Motley Fool mailbag episode. We've given you well and truly plenty of reason, plenty of requests, and frankly, I've just about begged you to like, review, and subscribe. So please do that if you haven't already, but I'll leave it there. If you are on the socials, jump on. I'll do it in reverse just to change it up a little bit. info@fool.com.au is the best email address to get us on. Our member services team will get your emails to us, which will be good. If you're on Facebook, and who isn't these days, even your grandmother's on Facebook, go to facebook.com/The Motley Fool Australia or /Scott Phillips Money. If you're on Insta and or Twitter, My handle is TMFScottP on both. And the Motley Fool AU is the handle on both. And if you're only on Twitter, or if you're on Twitter as well, but you want to follow Andrew or Strawman, you can only do that on Twitter. He's exclusive to Twitter. I'm sure there's an endorsement deal coming at some point very soon. You can
I wish.
No, I'm saying you're going to pay them. No, I'm kidding. You can jump on Twitter
No.
at Sage_Simeon or at Strawman Invest, and you can get all of Andrew's goodness directly to your Twitter feed. Jumping on the Twitter machine, and you'll get it all there. Fools, thank you very much for spending some time with us. Thank you for listening. We'll be back next Friday with another dose of Foolish Insight. Fool on.
See you then.
The Motley Fool and people appearing in this program may have positions in the companies mentioned. General advice only. Please speak to your financial professional to understand how it may pertain to your situation. Subscribe to the free newsletter at fool.com.au/MMM. The Motley Fool operates under Financial Services Licence 400691.